Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. Last month, I stated, and I quote, "This market has recently been one of unfulfilled disappointments. It has all happened since the unfulfilled potential of the late summer ascending broadening wedge pattern, which deviated with a false break lower and tempted all with a possible mid-September to date bullish halfway hesitation. It has all been a series of unfulfilled disappointments." End of quote. I still feel that way, probably more strongly in fact, as a couple of the recent patterns have bitten the dust. The first one I'll deal with is the monthly key reversal down in November. Now, you and I both know that one should not expect any immediate action or reaction to what is, after all, a long-term pattern. However, the strong pullback up in December over half of November's range is not encouraging for this new long-term bearish pattern. In part, I suspected something like this last time when I pointed out how there was no corroborating move lower in any other oilseed or vegetable oil. The next pattern to have its hopes shattered, or at least severely curtailed for now, has been the possible June to date bearish bump and run reversal top. Again, I said last week that I was in no way certain of even this pattern, as it was the latest in a series of revolving door patterns that have cropped up. However, the recent action was suggestive of such a pattern, with the trend line split for this pattern currently either 631.5 or 627.5, depending where you measure from. The market has not attempted to trigger such a pattern, so I suppose you could call it still a possibility, but I'm not overly hopeful, as this action has advanced a little too far to really be such a pattern. The next disappointment is also the most recent. It was to look at the most recent action since mid-November as a possible, new, quite wide bear channel, currently 589.5 to 644.5. Now, we saw a break higher over the upper bear channel line last week, but there was no follow through higher. Instead, the market has returned to the upper trend line and utilized it as a resting place of sorts. Now, the only thing left is an old idea from many weeks ago, when I looked at the action since mid-September to date and thought we might see one of the following: a bullish halfway hesitation, a head and shoulders top, and or an ascending triangle. The last option, the ascending triangle, is perhaps the nearest to what we have here. Thus, I will be looking closely to see if the market will work within such a pattern, now which can be either a bullish or bearish one, though data indicates they tend to be breaking upwards something like 6 to 7 times out of 10. I'll keep a close eye on that, as an idea at least. The one thing that may help this is we have the rising medium moving average, currently at 609 3/4, entering the mix. This is the first time it is coming so close to the market since June and July, when it successfully defended a few key market drops. As I said at the beginning, there had been some disappointments here in recent times, and I'm not altogether sure there'll not be more ahead. Winnipeg canola. There were, as I've previously stated here on many occasions, two patterns in operation here, both having run to fruition. They were originally a descending triangle from early July and a sideways triangle also from July. The targets for both of these were reached 4 weeks ago, and since then prices have gone sideways, yet seemingly held up by the extension of the broken lower uptrend, currently 976.80, of the sideways triangle. The recently broken ascending expanding wedge pattern formed over late October and most of November failed to make an impression, which leaves me contemplating this market and what structures are being constructed here. You see, though the broken extension of the lower uptrend trend line of the sideways triangle has superficially been the reason we've moved higher, I suspect in reality the two rising moving averages, the medium currently at 920.20 and especially the short medium one, which is currently at 961.40, that have been shadowing the trend line extension, were the main reasons. For the market to turn around back up, there is causing all of that action to happen. There is one fly in this ointment. The two rising moving averages seem to be separating and reducing their potency. Additionally, the move up seen at the turn of November into December has since run into the same congestion in the 1007 to 1008 area that had been there over November, and actually dates from May when the market last tried to push up through those levels. It therefore seems we have some pretty strong supports and resistances below and above the market. Almost a bracketed market. The question now is whether the market will be squeezed or get squeezed by the rising trend line and moving average combinations. I'm not sure, to be honest, but I do know that the trend line and the moving averages are rising each day by about $1.70 Canadian a day. There is a chance that each will start interfering with the other properly from the start of 2022. You can see a possible preamble to this with the lack of a higher market in recent days and the downside being restricted. It's an interesting run into the end of the year. Now, one final thought. Perhaps, just perhaps, we have since October a possible sloping roof, or sometimes known as a half diamond pattern. Well, this last bit is just a thought at this time, but if it develops, I'll develop with it. Bursa Malaysia crude palm oil. First off, please continue to try and ignore the color changes in the labels on the daily chart. There is no special significance to them. It's just my charting system playing silly buggers again. Anyway, the move up from the low to the high back 12 weeks ago gave us a weekly key reversal up that very week. The follow-on higher, especially the gapping moves higher, gave us a rare monthly key reversal up here in September. These were the final elements of a very, very large bullish pattern. It's the whole of May to October action, including the sideways weeks over August and September, was an extended V bottom. Now, this pattern is not that common, but it did have some heavy merit here at the time, and by heavy I mean some really heavy merit. Eventually prices peaked a little under 53.26. Since mid-October when this happened, we'd mainly gone sideways, or rather supported, yet at the same time piercing the middle line. That's currently at 52.90 of the bullish Andrews pitchfork for the 2021 action. The piercings of this middle line initially had limited effects, but 3 weeks ago, prices on Tuesday, the 23rd of November, made a combined key reversal down and bearish engulfing pattern and bearish opening black Mariposa. They were followed on the Wednesday by a hammer pattern, both consecutive days closing below the middle line. Since then, prices tried making an erratic attempt lower, below the rising short medium moving average, currently at 50.40. And this past week, on the Wednesday, punching down through simultaneously, which actually counts for a lot if you think about it, which both simultaneously through two key supports. The medium moving average, currently at 47.78, and the May high at 47.69, with a bearish opening long black Mariposa. Then came yesterday, with a gapping open lower that was since filled in, but which interestingly opened right on the March 2008 previous all-time high at 44.84. This 44.84 level was the lowest the market could reasonably open on without infringing two other key supports that are the core of the current move higher. They're the lower tine, currently at 44.64 of the very same bullish Andrews pitchfork for the whole of the 2021 action. Plus its close partner these past months, the rising long moving average, currently at 44.01. These two additionally sit within the congestion generated between approximately the 50% Fibonacci line for the whole of 2021 at 42.88 and the 4600 area. This leads me to my final point, which I detailed from a few weeks ago, and I quote again. Finally, the simplest and perhaps the most bearish of all the ideas is to look at the last 5 weeks and this week as a potential topping action. Again, it is still too early on this, but the longer we stay up here doing nothing much other than ranging between the all-time high, or let's actually say the new downtrend from the all-time high, currently at 52.48, and the support in the 5,000 to 4,900 area, then the more this pattern may grow in traction. I just wish you to know that you should not be immune to this idea. I will comment more fully on this one as I see things happen. I think I'll leave it at that for now. I can only say what I said this time last week again. I'm hoping next week things will become more clearer, but they probably won't. And that's the end of the quote. Seems this week the market may have finally triggered, in part at least, a topping action alternative to not going anywhere. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Tofpik and ADM Investor Services International Limited. And here comes the final bit.